If this overall Middle East conflict settles across in the next 20-30 days, my understanding is then also there is some bit of, I would say, a blip to the entire macroeconomic.
How do you see this policy action going forward? Do you see a pause to continue, or do you see, with the deterioration in macros, do you see interest rate hikes going forward? Hello investors, welcome to Moneynomics by Axis Mutual Fund. I'm Shalini Gautam and I have with me our head of fixed income, Devang Shah. Today Devang will be talking to us about the developments in Middle East and their impact on fixed income markets and the economies globally, the policy outcome that happened, and how is he positioning in fixed income. So Devang, let's begin. How do you view this? The changes have been happening daily, but overall, what is the view on the conflict in terms of how they are impacting the economies and the fixed income markets globally?
Right. So from a fixed income market perspective, first of all, Shalini, let's understand that the macro environment for India has actually deteriorated. So where we were like for the last 3-4 years, we have always been very, very positive on the macro environment for India. Like we have been in this Goldilocks period where we've had this positive CPI trend, where CPI was significantly lower, fiscal deficit consolidation, you had this current account deficit significantly under controls, you had and a strong growth environment. I think what we need to understand first is that obviously no one knows when this entire conflict will end. We are all happy with the ceasefire announcement, but there has been a lot of flip-flop around both US administration as well as Iran administration. So we don't know when this will come to an end. But let's based on some assumptions, let's build across how do we look at the macro environment. If this overall Middle East conflict settles across in the next 20-30 days, my understanding is then also there is some bit of, I would say, a blip to the entire macroeconomy. And how do I look at it? Growth, where we were all projecting about 7% for the full year next year also. I think for FY27, our assumption is it will tilt towards 6.5. It can be a tad below also. When I look across at the second variable, which is inflation, though RBI has given an inflation outlook, which is very, very good at 4.6, and they have assumed crude at around 85 and rupee at 94. With that assumptions, inflation for the year is around 4.6. I think there can be a slightly upside risk to it, with our assumptions around 4.75 to 5% for the next year. Thirdly, I think important perspective is current account deficit, where we were all expecting current account deficit to be around 1.25%. For the last 3-4 years, that has been the case for India. Because of this rise in prices, the current account deficit will probably go closer to 2%. So when I look at the overall math, where you have some bit of rise in inflation, a bit weakening on current account deficit, and because government has actually borne the cost for fiscal of the price rise in crude, I think the fiscal deficit also can see some bit of pressure if the tax collections weak.
Okay.
So how I look at it is, first of all, there is I would say some bit of weakness on India macro, but it is not too much if the entire conflict settles in the next 1 or 2 months. If this extends beyond May, and we continue to see higher crude prices, we continue to see shocks to the overall environment external sector, there can be significantly pronounced shocks to the growth as well as on the inflation side. So there the overall outlook can be a bit more weaker than what we are envisaging. But our base case is this settles in the next 20-30 days, and with those assumptions, I don't see a significant hit to the macro, but definitely from where we have been all throughout for the last 3 years, where macro India story was very, very strong and intact, I think it has a bit weakened.
Okay. So let's talk about the monetary policy action that we saw. This was completely in line with our fund house view. How do you see this policy action going forward? Do you see a pause to continue, or do you see, with the deterioration in macros, do you see interest rate hikes going forward?
So Sani, if you'll ask me, yesterday's policy was very important, because very important to understand what is RBI thinking. Okay, the general playbook of a central bank at this point of time, where you have worsening current account deficit, you have possible inflation shocks, and crude going across for an economy like India, where you import a large part of the crude oil, where crude is flaring up to 100 and beyond $100. The concern was, what will RBI do? How will they look at FX policy? Will they merge the rate and the FX policy and probably act like in 2013 when currency had significantly depreciated? RBI had it hiking. So there's a lot of fear and I would say concerns among investors. RBI has done a superb job, if you'll ask me, by communicating that at this point of time, they are very, very focused on the growth inflation dynamics. They've tried to soothe up the nerves by also stating across that the projections, when they're looking at growth, inflation, they're not seeing shocks anywhere. And the good part is they continue to advise that they will keep financial conditions easy, maintain positive liquidity, and in fact, in the post-policy press conference, RBI did mention that the inflation is not looking so bad. And if it is not looking so bad, we are not in a hurry to hike rates. So how I look at it is, I think policy was a significant positive policy from our perspective. It was neutral for rates. RBI didn't change any rates, but it was very, very neutral to calm the market nerves. Somewhere down the line, the message which we understood is that if, and I'll again put across that caveat, if this settles in the next 1 month or so, and we don't see crude prices settling around $85-90, I don't think RBI is in a hurry to hike rates. And we believe that the next 2 policies or so, RBI can continue to remain on a pause. After that, depending on how the inflation situation pans out, because we have a possibility of an El Nino also this year. If that comes, then possibly there is a trend of an upward CPI projection, and which can lead to, in the second half, possibly a rate hike. But I would say for till the near term, next 2 policies, I don't anticipate RBI to hike rates. If crude price, and our risk to the view would be if crude prices sustain above 100, then I think RBI from June onwards, every policy will be live for any rate action. But that's a caveat, that's not our base case view. Our base case view is that RBI will be on a pause, and the guidance which RBI has given is very, very positive. So with that context, we'll say that probably for the next 2 policies, we don't anticipate any hikes.
Okay. Now, bond yields had increased globally in the last 1 month. Do you see any opportunity for investors in terms of a tactical duration? What are the strategies that you have been seeing in the bond market?
So see, you're rightly pointing out that I think it's not only India, I think globally also yields have gone up, and yields have gone up meaningfully. Look at Japanese yields, look at German bonds, look at US Treasuries, look at Indian bonds. Indian bonds, if we see actually in the last 1 month, they have gone up from 665 to 710. It peaked at around 710, 10-year GSEC, and 30-year GSEC went up from 740 to 785. So there has been a 30-40 basis sell-off, meaningful sell-off in bonds. Also, when I look at the corporate bond segment and the money market curve, they have also significantly sold off by 30 to 40 odd basis. So yes, if I look at the overall bond pricing, and after listening to RBI yesterday, I think somewhere down the line our markets had got over cautious, and somewhere down the line were aggressively pricing in rate hikes. So that is why we saw this relief. The ceasefire as well as the entire RBI commentary yesterday has actually led to part of this sell-off which happened, or the rise in yields which happened over the last 30 odd days. We saw actually a reversal. My understanding is, I would say at the current level, where 1-year CDs are still above close to around 6.75 to 7%, 2-year, 3-year corporate bonds are close to 7.30, 7.50 band. I still believe they are slightly pricing in rate hikes, and that is the segment where, if we don't expect RBI to hike rates for the next 2 policies, that is the segment where investors can stay invested. So for, I would say, the near term, our view is that investors should be looking at shorter duration funds, money market strategies. Our portfolio tilt have also been happened toward, we have been reducing duration now for almost 6 months. We advised the clients to stay invested in the short end of the curve. That is what is our view at this point of time. So largely core allocation in fixed income, tilt towards money market and conservative short-term bond funds is what is our advice. But you asked a very, very fair question, that after this sell-off, does it make a sense for investors to take some tactical bets on duration? I feel that gilt funds at this point of time, because 10-year GSEC, and when we have looked across in various rate hike cycles and different time frames, the curve gets flattened. Today also 10-year GSEC is at 695, 30-year GSEC is at 760-65. So the spread is significantly higher. What we advise clients is, if supposedly, again, for some reasons, yields go up above 775, you can start investing some portion tactically into long duration funds. But I would again put across, when the 30-year GSEC yields goes above 775, some bit of allocation or some bit of small tactical allocation to long duration funds makes sense. Core allocation, if I summarize, continues to remain in the short end of the curve, which is money market and corporate bonds, and the tactical allocation above 775 can be long duration funds.
Okay. Thank you, Devang, for your insights, and a big thank you to all our investors. Stay invested.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.